Welcome to the Q&A YouTube Live with your Life Benefits team today. I'm John McPhee, and here with me today,
I'm Tom McPhee.
And I'm Michelle McPhee.
and I get to call these people Mom and Dad, so it's really nice. We live in interesting times. You probably didn't need me to tell you that, but a lot of interesting things happening with coronavirus pandemic right now, and also with the stock market correction that has gone along with it and everything else that's happening. There's a lot of concern out there, and people want to make sure that they're making the best financial decisions in times like these. A lot of you on this meeting today are clients of Life Benefits, and you have healthy reserves in your cash values that are accessible during times like this, and that gives you a lot more safety and a security net that a lot of people just don't have today. So you've been asking a lot of really good questions by email, by phone, and we wanted to take a few minutes today to share these questions with everyone so that everybody can benefit. If one person has a question, chances are 2 or 3 other people have the same question. And so that's what we're going to be doing here today. As you have questions that come up during this live meeting, you're welcome to type them into the live chat. I have the computer right here in front of me. We'll be monitoring those questions in the live chat as we come in. We can get to any of those as time allows. If you're watching this on YouTube Live, but you're not logged in with your Google account, you may not be able to participate in the live chat. In that case, if you have a question you would like us to answer live, go ahead and email it to me. My email is John, John, at life-benefits.com. I have my email here on this computer as well, and I'll check that from time to time as we go through here. Now, we have a number of questions that people have asked over the last week or so. And we're going to be going through some of these. The first question on the list is from David. He says, if SBA loans are lower than a policy loan, should I take an SBA loan? Who wants to take that question?
Well, that's a really good question. It's one that comes up often, not just in a pandemic or a market crash like right now, but in the fact that do I take a car loan that I can get at 1.5%, or do I take a policy loan at 5%? And it really comes down to this. Which one is going to cost you the least amount of money? We're going to pay interest on either loan. Now, granted, the interest that you're paying on a policy loan does make the insurance company profitable. You are a participating owner in that company, so you will see some type of feedback, maybe in dividends because of that.
Sure.
But that is not the reason that you should ever take a policy loan, basing on the fact that you're hoping that dividends are going to recover the cost of the interest. The cost of an interest is a hard number, and it just makes a whole lot more sense to use somebody else's money if it's cheaper and save your money for some other incident that might be more urgent or might be more profitable for you.
That makes a lot of sense.
So, and it's not, some of these questions or some of the answers to the questions aren't going to be just yes or no, but
true.
Kind of a thinking process. So with the SBA loan, if the interest is lower than what the policy is charging you, that might be a good idea. However, if you're not able to keep up with the loan repayment and you've taken that SBA loan, well, then you can always get a policy loan to help you make your payment, or a policy loan to pay that off and then set your payment at a schedule that's more convenient for you. So you have options.
Yeah, and here's another thing too. If you apply for an SBA loan, especially at a time like this where lots of people are applying for SBA loans, how long is that approval process going to take? It could be a few weeks, and so you need it's good to have a reserve. Maybe you will need to use a policy loan during the first few weeks while you're waiting for that SBA loan to come through. So it's good to have that option.
And that reserve is really important, and that's why we are so excited about participating in whole life insurance, because it provides that reserve. You know, the average American today has less than $400 in reserve, and that's not going to go very far when there's a situation like this where people are getting laid off work, they're not being able to go back to work, even if they haven't lost their job, and other expenses are coming up where we're trying to maybe stock up a little bit more than we normally would because we really don't know what the future is. That cash value comes in really, really handy.
It does. By the way, hi Julio. I see you on the live chat. Thanks for checking in from Florida. So
All right.
what's the next question here that we have in front of us?
Well, this was actually one of the very first questions to come in, even before we were asked to quarantine. And Pedro was considering purchasing a house. I think they were getting close to signing paperwork, and he called in and he said, "Wait a minute. Should I still buy this house? What if the market goes down? Would it be in my favor to wait?" And so he wanted to know, should I proceed with this purchase?
This is the time that you wish you had a crystal ball.
Of course, of course. But there's a lot of times we wish we had a crystal ball.
Yeah.
And really, this market, the market that we're seeing, the coronavirus, the economic, I was going to say depression, but it's kind of a stall right now. The economic situation we're in, it's not like in 2008 where it was a market correction with real estate. So I don't know that what's happening is really going to affect market values. Of course, it might. Anything could affect anything, but there's probably some other factors to think about in there. And actually, with the quarantine coming, I doubt they were able to go through with the actual purchase, at least not the takeover time. But, he had a good interest rate on the loan. His job, if it wasn't affected, it's probably not a problem. But, just kind of think it through. And then it was interesting because while I was on the phone with Pedro, I thought of the scripture in Jeremiah where in the middle of all their problems that they were having in the book of Jeremiah is told to go out and purchase a piece of land and record the deed. That, for those of you interested, that's Jeremiah 32, 1 through 15. So even when there's problems all around, we have to go on with living. People will be born, people will graduate, people will get married, life goes on.
Well, this reminds me of
silver
when
lining.
we were first getting involved in this type of life insurance and building cash values. We actually took a home equity line of credit on our home when the market value, just before the market value crashed. So we were sitting in a piece of property that was worth less than what we owed on it, which a lot of people were at that time. That doesn't mean that it still wasn't worth it to us. Mm-hmm. It was worth it before the market crashed for us to stay there. Our job wasn't affected. We were still able to make the payments on it. And it was a good home. We held on to that till the market corrected, came back up, and then it was an opportune time to sell it. We made a profit on it and moved on. So, any market can be affected by anything, like you said. And if we continue to see people being laid off and not being able to go back where we could see a market crash in real estate because people are going to be not being able to afford their mortgage premiums. Mm-hmm. But at the same time, that shouldn't be the decision that you have right now, whether you should buy property or not. If you've gone through the due diligence and this is something that's going to fit your needs, not everything can be put on a data spreadsheet. This is an emotional decision as well. You got to live someplace where you're going to live, and something you're buying or something you're renting. Mm-hmm. That's a choice you have to make.
That's true. Yeah. So hello, Kathy from Texas and Malachi from New York. Thanks for checking in the live chat. If you guys have any questions as you're watching this Q&A session, please go ahead and include those in the live chat as well. Hello, Giselle from Canada. Any questions that you have, put them into the live chat, or if you're not logged in as you're watching the YouTube live, you can email those to me, john@life-benefits.com, and we'll get to those questions time allowing.
So right now we've got another question that came in from Nick. He said, should I use my cash values in my policy to buy investments while they're low? To make an investment while prices are low?
It is now the opportunity of a lifetime.
Well, this always goes back to not what typical financial planners want to say and talking about risk tolerance. It actually goes into your loss avoidance capacity. So there's very few people that I know of that would be willing to risk $1,000 to make $25,000.
$25,000 or $25?
$25.
Oh,
yeah.
No,
How about
no.
risking $1,000 to make $100?
No.
Would any of you do that?
And yet on the podcast
don't
the
think
other
so.
day, we were talking about this, John, and that would actually be a 10% rate of return. And so
Yeah,
when
different way to
typical
look at it.
financial planners start talking about this high rate of return that you're going to get, double digit, 10%, that could be enticing. And they might say, well, you're in a good risk category because you're young, you're healthy, or maybe you really need to take this high risk to make a lot of money. But it all boils down to what is your loss tolerance? Are you willing to give up $1,000 just for the possibility of making 25? That's what you have to look at here. And if you're not in a position where you could easily recover that money, either through income or from some other source, then maybe you need to think twice about buying even when prices look really, really good as the market drops, or selling when the market gets really high. That's a question that you have to ask yourself internally. Nobody really can make that decision for you.
And when he's talking about investments, we have to remember that with investments, we have the risk of losing everything that we risk. So if you want to, buy low and see where it takes you, just realize whatever money you're going to use to buy low, if you're okay with losing that, then it may be a very good investment for you. But if you're not okay with actually losing that, then it's probably not a good idea to make that investment. Of course, we hope you don't lose it, but you have to realize there is that potential when you make an investment.
That's right. Hi, Dr. Corin from Pennsylvania, and a couple questions have come in here as well. Hello, Dr. Hill. So one question here from Malachi: are any of the insurance companies that we use at Life Benefits considering taking any of the stimulus bailout money?
Well, that's a good question. I haven't heard any reports of that. As these are all mutually held companies, it would surprise me if they do.
Yeah.
They're not publicly traded companies. And they really, the companies we represent have all sent out information which reassures us of what we already know. And that is that life insurance companies are really, really secure in situations like this because let's say in our podcast, our YouTube live yesterday, we talked about what happens when someone pays a term policy premium and what the insurance company does with that money over a long period of time, maybe 80 to 100, 120 years. 2% or less of term life insurance policies ever pay a death benefit. That means the insurance company gets to keep that money and keep earning a long-term investment on it for 80, 100, 120 years. And in that time period, they recover the cost of if that person died by the person owned that policy.
So it's definitely a very long-term strategy here.
Now,
it's not an overnight thing.
In the meantime, what about the 2% that do die before they've recovered their money? And that is why they sell whole life insurance. We are their equity partners. We provide the equity by having higher premiums, and we are willing to earn dividends on those returns. And so that's why life insurance companies, especially the mutual companies, are very, very stable in markets like this. And if we look back in 2005, 2008, 2007, our dividends have been pretty consistent all the way through, whereas the stock market has jumped all over the place since 2007.
Yeah,
Well,
it sure has.
And insurance companies, they have huge reserves. So, I mean, they're planning long term, but they have to have huge reserves because they never know how many people are going to suddenly die in a year. And so they have to plan for that. And right now, insurance companies, they're all still working. None that we represent have closed down. Most of their people are working from home. I'm talking with underwriters, while they're at home. And this isn't too unusual because I know underwriters often work from home. Sometimes I'll get emails on the weekend saying someone so-and-so is approved. So, they're still working behind the scenes, and every day emails are coming in talking about the strength of their company.
Yeah. And it's important to know that ever since the mid-1700s, that actuarial science has been perfected to the point that the insurance company knows exactly how many people are going to die in pandemics. They know exactly how many people are going to die from terrorist activities. They know exactly. They just can't tell you who. And so when they're dealing with the science of large numbers and actuarial science, they have the statistic already figured out. They're not going to assume more risk than what they know they can cover. And that's the other reason that we see such a stable return on our policies.
Yeah, so in other words, are the insurance companies getting any bailout money? Probably not, because they don't need it.
Yeah, there we go.
And if you look at the dividend history of companies, that is the profits that they're making every year. A lot of these mutual insurance companies, because they're planning for the long term, like you said, they're planning this out so long that they are consistently making profits every year. For many of them, that goes back all through the market crashes of recent years, even all the way back through the Great Depression for many companies. So that's good to have in mind there.
It's good to remember, too, that here a few years ago, Jesse and I were at a meeting in the Midwest with one of our insurers. And I asked the CEO at the time, who had formerly been the chief financial operator, what happened in 2007 and 8? How much did you lose as a company? And he said, well, at that time, I was the CFO, and I was managing an $18 billion portfolio for this company. And we lost less than $300,000.
That's amazing.
Which is way less than 1%. And that's the stability that we have, because we're dealing with companies that are working for us. They're not out there really trying to make a profit on anything other than making sure that our death benefits are covered.
Yeah, and they did pay a dividend in 2008 as well.
They did.
So
in fact, as many of the companies that were represented, we just got a letter from 127 years of consecutive dividend paying to their policyholders.
That's cool.
Yeah.
That is long-term security and stability. That's good to have. Another question here from Dr. Hill. He says, is now the time to leverage SBA loan? Does it make sense just to have even an SBA line of credit under a 7A loan? That must be a section of the SBA. What are your thoughts on that?
Well, and that's kind of goes back to that question we first addressed. Should we get an SBA loan? It's a great time. I mean, sure, you can have it there and ready, available for you. The loan interest rate may be less than what you would pay for a policy loan. So that may make good sense to have that out there. You know, if you need money to put into your business, but then maybe you need something on the personal level, your policy, you can borrow that for anything personally. You can't get an SBA loan for something personal. So be thinking about that, having resources for both.
Years ago, I took an SBA loan out that I didn't need, just for a reserve, because we didn't have the emergency funding that we needed at that time. We just recently moved, started a new practice, and our reserves were low. So that SBA loan was there just in case. And cash is king. Yeah. It always is. And if you've got the ability to repay the terms on that loan, I would say this is a great opportunity. It's very similar to what we did with our home line of credit. Did we really need that capital at that time? No, but it was just sitting at the mortgage bank. Why should we let them use it? You have to be responsible with this, though. Just because you take the loan doesn't mean you go out and spend it on something, unless it's going to create a higher value than what the loan is costing you.
And depending on the interest rate, too. Compare the policy loan interest rate, compare what the interest rate is on the SBA loan. If you need funds, then you can make a simple choices where to access those. And if you do use the SBA loan instead of the policy loan, realize that you still have the money there in your policy loan, that if something some emergency happens or gets worse, then you can take a policy loan, make a few payments, or even pay off the SBA loan if you need to.
One thing you do need to remember, and I don't know all the details about the SBA loans that are being offered here, but a policy loan is an interest-only loan until you pay the principal back. I don't know if the SBA loans that are being offered are interest-only loans, or if that interest payment is waived and somehow, or if the principal is waived. So look at all the details, but interest only on a loan is going to be much cheaper for you cash flow wise, if you're thinking about this is a time of cash flow crunch, than maybe an SBA loan that would provide require that you pay back both principal and interest. So those are the things you want to consider when you're thinking about where can I tap in for extra cash flow at this point?
Well,
Yes.
and we mentioned a few minutes ago too that you could take the SBA loan and then refinance with yourself by taking a loan from your policy and paying that SBA loan off
Yes.
if you needed to. So
Certainly.
with the policy loan, the cash value you have in your life insurance, you have options.
That's right. A couple of other questions here that are somewhat related. Julio says, can a policy annual premium or a policy loan repayment be deferred due to a furlough? Alex, hi Alex, says, if you normally pay your premium for the whole year in a lump sum, can you switch to a monthly level later on, spreading out that money when the times are a little lighter?
Yes. Okay. So we can.
And I think this is similar to the question that Isaac had as well.
Mhm.
Since my income isn't high right now, is there a way to pause or decrease my policy payment? If I borrow from my policy, what will the monthly payments be? So we have two things here. One, can you do anything about the policy premiums? And two, what about loan repayments on loans that you might already have out?
Right. Okay. So I'll take this one.
Okay.
Okay. So if you're making an annual payment on your policy and you want to change to monthly, just contact our office. You can change to monthly. That's no problem. Of course, if you've been paying monthly and you want to go to annual, when you get to the year anniversary date of your policy, let us know. We can make that change with the insurance company. So you have flexibility about the mode of your payment.
So I just heard two things from you. I would like you to clarify this.
Okay.
You said if you want to go from monthly to annual, you can only do that on your policy anniversary date. But if you want to go from annual to monthly, you can do that right now. Is that correct?
No, that's not.
Okay.
Because annual, that would also happen at your anniversary date. Because if you're paying annually, let's say you paid from April to April, then come April, you can change it
Okay.
to a monthly if you
Sure.
want to. If you paid from April to April and you're in October, there's no need to change it at that time.
That's correct.
You just wait till the year comes around. So pretty much at your anniversary date of the policy, we can help you with that change. Just contact us and we'll help you with that. The other question is, what do you have flexibility in what you're paying? If you have a flexible paid up rider, yes, you definitely have flexibility. You have to at least pay the base premium of the policy. I know we're getting a little technical here. And then the flexible rider, you have some variation in that. So again, contact our office. We'll help you figure that out. Another option is sometimes people have a little difficulty with cash flow, and people whose businesses are affected right now, that may be the case with you. And if you're in that kind of situation, you might even borrow from the policy to pay some of your premium, and we can talk about that as well. So just contact our office.
And that's not usually something we recommend because it's not a good long-term strategy. But short-term, it's definitely an option to borrow from the policy to help with the premium during times when cash flow is tight like this.
Yeah, so that's a nice option that you have, and just contact our office for details. We'll help you with that. Sometimes people do that, maybe for a short period of time, and then they get back on track, and we'll even help you figure out how to get caught up on that.
Sure, because people have gotten laid off, or they lose their job, or they've gotten sick without having a waiver of premium on their policy. And we've been able to help many people keep their policies and their business and their home by using policy loans during that short crisis period. Then they can get back on their feet, and when things get better, they can replenish it.
Yeah.
Okay, and so Sandra also had this question about what about my loan repayments? Can I change the amount that I'm paying on a loan repayment? Absolutely. With the insurance company, it's only an interest-only loan. So if you have been making a loan repayment, you can stop that. If you've got it set up to automatically draft with the insurance company, just contact us and we can let them know you want it stopped. And then, once you want to start it up again, we can start it up again. Or if you want to change the amount, you can do that as well. You have that flexibility. And then also Joe specifically had the question, what about my loan interest? What if I don't have enough to cover my loan interest right now? Is there something I can do about that? and Joe had policy cash values that could cover that loan interest. How that works is the loan interest gets paid from the cash values. It increases the amount of loan you have with the insurance company, but you don't have to come up with anything out of pocket.
Nothing out of
Again,
pocket.
a short-term strategy. I helped another client with this today.
Very
All
good.
these different options are so cool, and that's what is so neat about this. It's not like, oh, we've got to make a decision immediately. There's flexibility here, and the companies that we represent have done such a good job at giving us products that we can offer to the public that gives them so many options. It's just incredible.
That's right. Great questions, guys. Keep them coming. You're a smart bunch, I can tell here.
Yeah.
It's fun. So another question from Rebecca. Hello, Rebecca. How long is it taking to process loans right now? That's a good question. Is it taking the insurance company any longer than usual during these times?
You know, I know we've had a lot of loans that have come through our office, and we get them submitted to the insurance company. I have not heard of any delays. Once in a while, we'll have a delay at an insurance company, and we'll find out, oh, that department is short-staffed right now, and this is happening and that's happening, and we got to work through that. But I haven't heard of any delays, and so that's really great. And I know that the insurance company home offices, people are really working extra to get things taken care of, and I just have not heard of any delays.
And I just took a policy loan on Friday. So I requested a policy loan. It was already towards end of business day on Friday, Eastern time. I requested a policy loan from one of my policies because I have an investment that I'm thinking of making during these times. And so I requested the money, and it was in my bank account on Tuesday. So
wow, that's really
no
fast.
delay at all. I mean, I did the electronic, the EFT deposit. So I filled out that form, and really fast.
So
No
that's really
difference
like
from normal.
24 hours because they got it late on Eastern
Monday,
time. And
then it was there on Tuesday. So
Yeah.
24, 48 hours.
Yeah.
Business days.
Which I just want to say, that is actually very speedy because I think it usually takes a little bit longer for a policy loan. So
And you might find this interesting. When you take a policy loan, the insurance company is taking that money from money that they have in reserve. There's a certain amount that the insurance company has to keep in reserve to accommodate policy loans, to pay a death claim when somebody dies that owns a policy with that company. And so when you take a policy loan, they're actually lending you money from that liquid fund. And so the money is usually very accessible and not tied up in down market conditions at all. So great question, Rebecca. Another question from David in Georgia. Hello, David. Assuming the worst case scenario of not being able to borrow from a policy, what would happen if premiums are suspended for a year or two?
I'm thinking as in you couldn't make a premium
Yeah,
payment?
so let's probably not being able to make a premium payment. Is that what you had in mind, David? You want to clarify a little bit?
Well,
in the
let's
chat there?
if somebody can't make a premium payment, then I would say let's see if they have cash values to pay the premium. Maybe they pay on a monthly basis so that if they can, catch up, that might be an option. But if you can't pay your premium at all, then the policy is going to lapse because it needs payment. So once it lapses, you have up to 5 years to reinstate it. Sometimes that's a good option. Sometimes it isn't. Sometimes we just would recommend a new policy startup. There is an option. I was talking to someone just the other day. They do have some cash value in their policy. Their life has changed completely from what it was when they purchased their policy years ago. And they're no longer able to afford the premium or the loan interest. And so we're looking at solutions. There is some cash value there. And we could use that to pay the premium for a little bit, but that's not a good long-term solution for her. So in her situation, we're either going to surrender the policy or have what's called a reduced paid up policy, where they will take the value. They're going to give us a quote on how much coverage that would be for her life. And then she would never owe another premium on that policy. It would still get dividends. It should still have cash value there, but it would just be greatly reduced. So those are a couple options for her. Not usually the option we want to see. So if you're having trouble with making premium payments, let's talk about getting the base paid for sure and see what your options are.
And David, he's saying, yes, it's assuming we can't borrow from the policy to pay it for a year or two.
Okay.
What would happen? That's what would happen. So
Yes.
those would be the options.
And we need to talk about one more thing at that point.
Sure.
At that time, if the cash value in that policy is greater than what you've paid in premium or your cost basis, if the policy lapses, you will owe taxes on the difference between what you've paid and what the total cash value was. So you have to be aware of that. If you're going to let a policy lapse, then there could be a tax liability in the future for you.
Yeah. And typically if a policy is that old at that point that we have more in cash value, then hopefully there's going to be a way that you could borrow from the value to pay the premium. But if you have it all borrowed out and that happened, that's kind of a worst case scenario type of deal there. So,
And then one other thing is if your coverage is going to lapse like that, you definitely want to get insured again. If you can't afford the whole life, then get yourself at least the term, and we can help you with that as well. But again, that's worst case scenario.
And of course, we're talking about policies that haven't become a modified endowment contract already. So single premium policies and policies that have become a MEC because of overfunding, then there's different rules about that.
that's right. Yeah, David says back 5 years is plenty. It's great to know that we have options. Yes, it is.
yes.
Isn't that so great during times like this?
Well,
it's one of the best things.
we're talking about being money managers, so we're not. I mean, we want to manage our money well, and a lot of these questions are just about money management.
It is. It's really all about money management because, you look at the people that have managed money very well in their life, and they're the ones that have learned how to keep it. If you take someone that's just an average hourly wage earner from 25 to 65, and they're just working out, making $12 an hour, they're going to make over $1 million in their life. But how much of it do they keep? That is the importance, and that's why we encourage people to follow the 10-20-70 rule. Keep at least 10% of what you're making for times like this. Get rid of your debt with the 20% of your income, live off the 70%, and when the debt is taken care of, now you can keep 30%, and eventually you'll be living on less than 70% of what you're managing easy, and that will just shift over into what you're keeping. So when we do experience times like this, and we have experienced times like these multiple times in our history, 1918, the flu epidemic.
Well, that was not my history.
1928, the Great Depression, 1958, 1941. All these times that have happened in our history where insurance companies have solidly paid dividends through. And yet many people go bankrupt in that time because they haven't used the traditional method of keeping their money, and that's in participating in whole life insurance.
That's right.
Well, in this, okay, it's time for story time.
Okay.
I think about when you talk about J.C. Penney, he went through the Great Depression, and he was going to lose his store, and he checked himself into an insane asylum.
Yeah, he lost everything. He lost all of his, I think he had 41 stores at the time. He lost his home, he lost his stores, he lost his sanity, and he went into a insane asylum. And it was during that time, one Sunday he walked by the chapel and he heard "God Will Take Care of You" being sung by the choir, and he goes, I have a life insurance policy that I bought back in 1921. And the cash value in that life insurance policy enabled him to borrow from it. Who would have loaned money to an insane man?
No SBA loan
No
for
SBA loan
J.C.
for
Penney.
okay. And he was
Yeah,
able
we're
to
still
take
getting
that
standard
money, buy
underwriting.
back his stores, and of course we know the rest. But we don't know the rest until we understand that years later, J.C. Penney came into one of his stores to teach people how to be more frugal in the gift wrapping section because he was a very frugal person. And he helped a young man named Sam wrap a present with the least amount of paper and the least amount of twine. And Sam was so impressed with J.C. Penney, he opened his own department stores. And now we've got Walmart, who just hired another 150 million people in this crisis. That wouldn't have happened if it hadn't been for J.C. Penney and his life insurance.
Cool. JC Penney story. Alex says, this is my favorite. Listen up, everyone. It is a great story, isn't it? Because JCPenney had money that was accessible during a time of crisis like this, and the rest is history.
So how
And
many of you out there are the next JCPenney? Only
We don't
I hope
know.
you don't have to go to the same side.
Yeah.
We have to
Don't
say
be the
another
same as I
story
would
here
to try
because
that.
Dr. Corin's on the line. And in Philadelphia, everyone in Philadelphia knows who John Wanamaker is.
Yes.
And John Wanamaker was the most insured person in America during his lifetime. And he was able to offer health insurance packages, life insurance packages. He was the first person to guarantee that if you bought something at one of his stores, you could return it for the same price. He was the first person that's talked about the truth in advertising. So if he advertised something at a price in a newspaper, you came in and you could buy it for that price.
So no haggling.
And people said, "Why are you so insured, John?" And he said, "Because with one payment, I have made an investment that will pay back my beneficiaries hundreds of times more than what I put in.
Okay.
One premium will give your beneficiaries much more death benefit." We all know that. That's what life insurance is. Number two, I can leverage that and not lose the growth on my money. And that's what we're talking about
Yeah.
right now. We can leverage this money for crisis and not lose the continued growth on your policy. And number two, he says, it gives me the opportunity, number three, it gives me the opportunity to spend everything I make and still leave an inheritance.
That's cool.
That's pretty cool. Yeah. Hi, Jason from Canada. Thanks for joining us on here. That's great. We have another question comes in here. It says, on the topic of keeping more of what you've earned, have you set up captive insurance plans for companies? IRS rules allow for up to $2 million a year of pre-tax dollars, but they must satisfy the strict IRS rules. Dad, I know you've done quite a bit of research on that. What's the verdict? Should a company pay premiums?
Every person's situation is different. And to answer a question like this on the air is not going to do a lot of people a lot of service. So if you want a detailed answer to that, please shoot us an email and we'll get that information out. There's lots of different plans. So if we look at Jim Harbaugh, for example, at the University of Michigan, the University of Michigan is loaning him $2 million of his salary, quote unquote, every year to buy a life insurance policy, which is really setting up Jim Harbaugh for his retirement. That's a very, very unique situation. You have to follow some very specific guidelines, and so I'm going to defer on that and just answer it on a case-by-case basis.
And typically for most of our clients, we find that it's worthwhile to own the policy personally and then make a loan to your business after you've taken the policy loan in the first place. And that's typically the way to go, but not always. Case by case scenario.
You can look at the Bank of America president, the CEO, and Comcast CEOs, and you look at Rex Tillerson, our former Secretary of State, who got a huge package with life insurance from ExxonMobil. We're talking about millions of dollars in these accounts. They're not, your average person's policies.
Yeah. So another question here: are whole life policies affected by the turmoil of this pandemic? Here, is there anything that could affect whole life policies like this?
Well, I just wrote an article about this.
David,
I think
by the way.
we're gonna publish it, or if it's already been published, I don't know, about how pandemics affect the market, and sometimes they affect it greatly. In 1918, it didn't affect the market at all. But by 1928, we were in the Great Depression, but that wasn't from a pandemic.
Sure.
All right. So, the 2009 pandemic, H1N1 virus, the swine flu, we were just starting to accelerate out of the 2008-2007 recession. So that pandemic didn't affect us at all. So a lot of it has to do with how people react, how the media stirs us all up and gets us excited. It's really pathetic and sad to see the people that are suffering from this coronavirus and the ones that actually die. But overall, when we look at it, statistically, we lost anywhere from a third to 50% of the world's population in 1918, and it didn't affect the market at all. So, that's, the insurance companies have calculated this into their actuarial science. They are prepared. They were prepared for all the people that lost their life in the Twin Towers and the 9/11 incident. They were prepared for the people that lost all their values in Katrina. Insurance companies are in this business. That's what actuarial science is about. what is the farthest risk factor that we could have? What is the standard deviation from the norm? We got to know that, and the insurance companies do know that as accurately as they can within large groups of numbers.
So I want to take this just a little further, and I want to say, okay, I've got my life insurance policy right here. How is the pandemic going to affect it? Well, you have guaranteed values in your policy, and it can't affect those at all because this is a contract. So you're set.
Yeah, and the bigger question is how would it affect the insurance companies? And like we just saw, really not even having an effect on the insurance companies. You go back historically and look at the different pandemics. The insurance companies have been paying dividends all the way back through those times, honoring the contracts. There's even companies that paid claims on both sides of the border during the American Civil War. So,
well, I think
that seems like a pretty close to a pandemic when you consider how many people in America died
during
at
that time period.
It is.
I will say that the biggest risk with your contract is you and your ability to pay the premium and the interest. The second risk is that if our political establishment does away with contractual law, which a lot of socialist policies are talking about doing, that scares me.
That would
because
be a problem.
We're talking about contract law. Contract law cannot be altered unless it is changed as a whole institution.
Artificially by the government.
And if that happens, folks, a lot of other things are going to change too that we wish wouldn't have it.
That's right. So another question here. Susanna says, my husband wants to know what he can do with his 401k from his previous job. He's currently 53. Wouldn't surprise me if a lot of people are rethinking 401k right now after what we've just seen happen in the market, how quickly it went down. There's pluses and minuses to consider on both sides of that. What would you say to that?
Well, this is real interesting. Just before this pandemic broke out, we did a presentation at our CPA office, and we were talking about that in early January of 2020, there were more 401k millionaires than ever before. It was huge amount of number. And yet Fidelity, which manages like 2/3 of the 401ks in this country, said those people were at huge risk because of something just like this. Now, what have they done? They have lost. I was reading an article the other day that the 11 top billionaires have lost billions and I mean, it just blows you away how much money they lost just in 2 weeks.
Wow.
And those 401k holders are there. We talked to people that have lost already 30 or 40% of what they thought was theirs. And I say what they thought was theirs because just because you're a millionaire 401k holder doesn't mean you have $1 million, because you've got to still pay the taxes, and how you pay those taxes depends on how you plan today. And so if you wait until you're 72, like the new tax law allowed you to, that was signed in December, before you start taking your required minimum distributions, then there could be a lot of money in that account that could force you to take a larger distribution from that, required distribution, so that now you could pay taxes on 85% of your Social Security. So many people are saying the best plan to do is on a widowed 401k, you're no longer under the rules of that 401k, to access that money and put it into something that's guaranteed, that can't be affected by the market. Some people opt to put it into money market accounts and keep it in the 401k. Some other people roll it over to a simple IRA. Others roll it over to a traditional IRA and then into a Roth IRA. So there's all different kinds of things to do with that money, but what is going to meet your needs, no one can tell until someone sits down with you and talks to you on a one-to-one basis and find out what your goals are, what your expectations are, and what you hope to accomplish over the rest of your lifetime. And that's what we do here at Life Benefits.
That's right. And so this isn't a decision that you want to make without considering all the different consequences of each option that you could take and find out. This isn't something that you want to jump and make a flying decision on. It's something you want to carefully consider. And this isn't, we can't provide advice on a situation like that, but it's good to know all the different options. What would happen if I did this? What would happen if I did this? What are the potentials versus what is the risk that I'm taking on by not doing anything?
I don't think people need advice, and 15, 16 years we've been doing this, I haven't met a dumb person about money.
Mhm.
All they do is they don't know their options. And so our job is to educate you and give you all the information about what is possible. And when you see what's possible, we always find out that our clients know what to do. It's just that they didn't know what was the possible thing to do.
Yeah. So look at those options, see what's going to be available there. Maybe you just change the allocation in the account. Maybe you look at doing something else. Something you may want to keep your eye on if you're considering this is, I know there was a bill that was being debated in the Senate just last night, I believe, that would create a special way for people that are affected by the coronavirus, either laid off or has somebody in the family that's sick with it, could access, I think it's like up to $100,000 out of the plan.
That's been discussed,
And
yes.
maybe they wouldn't have to pay it back, or if they did, they would have an option to pay it back over 3 years. So that may be an option if people are thinking about taking money out of an account like this already. Keep your eye on that. It doesn't seem to be law yet, but it might be moving in that direction.
One thing I wouldn't do if I was in that situation is I wouldn't roll that 401k into a new 401k with my new employer. I know I wouldn't do that. Because that doesn't give you any options until you're
Yeah.
59 and a half again.
So then you
Okay.
just got to ride the roller coaster of
Yes.
whatever the market's doing.
Yeah. Okay. Well, that would be a little bit tough. Okay. So, David, hey, I'm glad this has been helpful for you, David and Julio. Glad this has been helpful. Another question: what happens to contract cash value in the policy when massive inflation from quantitative easing and bailouts push the dollar purchasing power to zero? That's from Good News.
I
Username.
like that question because that's one of my favorite things about whole life insurance. When you buy your policy, let's say, John, when we bought your policy, you were 15 years old, your first policy. You're going to pay policy premiums on that life insurance policy as a 15-year-old for the rest of your life.
Yes.
That's cool.
And
That
yet,
was great. So glad you did that. for
and
me.
yet, somewhere
Thank you.
around year 7 or 8 in your policy, the premium you were paying was less than the cash value growth for that year.
True.
And so when you look at that, and then we see, oh, just a few years later, you've recovered all the money that we've paid for that policy. We've got more cash value than what we've paid. And yet each year when you pay that 15-year-old premium as a 15-year-old into your policy, let's say it's $2,000, your cash value now is growing by maybe 3, maybe 4, maybe 5 as it gets older and older, that policy gets bigger, guaranteed. That's a huge rate of return. That's a hedge against inflation. There
Yeah.
is no other thing out there that can do that for you.
Yeah, and paying decreasing premiums because the value of the premiums that you're putting in is going down if you're looking at their purchasing power. So it's nice to have that guaranteed foundation. And is it going to be foolproof against inflation? If inflation went like it did in 1923 in Germany, would that affect policy values? Sure, it would.
Yeah.
But also you have to take into consideration the world didn't end in 1923 in Germany when that hyperinflation happened. It didn't end in Argentina when they had super big inflation, or South Africa when something very similar happened. People will always find some system to trade
Yes.
for goods and services. And so there's always going to be some sort of system. And so it's likely that with the guarantees in life insurance contracts, if even you have that foundation, but maybe if hyperinflation, something like that happened, there would be some sort of conversion to whatever new system is going to be used.
At the same time, I've never found anyone that says, I don't want to buy this because I don't like $6,000 when I pay 2.
That's right.
If I'm going to pay 2, I want to only get $1,500 back. They're always excited about getting $6,000 back.
Yeah, absolutely. And when the policy is up and running like that, who wouldn't want to just keep paying the premium to get that type of return every single year? That's helpful whether there's inflation or whether there's not.
And whether there's inflation, whether there's pandemics, whether there's terrorist activity, whatever it is, there's so many what ifs. We can't base our decisions on all those what ifs. We just have to look at the information in front of us. What are the guarantees? What do we know? What seems the most likely to us? And we have to make our decision based on that. all the what ifs in the world. We can't plan for those. And if we try to, we will do nothing. And that will be worse.
That's true. And let's go back to when we did have high inflation in this country in the 80s. Prime rate went up to 21%. I remember graduating from college in 1985, and my college buddy, he got a house loan for 17% adjustable rate mortgage. He thought he was on cloud 9 because that was a great rate. Okay. At that time, which I didn't know at that time, if I did, you could have borrowed money from a life insurance anywhere between 5 and 8%.
So it doesn't, the interest rate doesn't increase with the market like that either.
No.
As quickly.
And
That's
so
good to know.
you could
It's a really good
literally
feature.
borrow from your life insurance policy and bought a CD at 12% and made money. So life insurance companies, because of their unique ability to use actuarial science, legally binding contracts, and this term life insurance and with equity partners buying whole life insurance policies, are in a wonderful position to be able to protect your capital. And that's why we use them as a place to keep your money so that you don't lose more of it and keep transferring it to other people throughout your lifetime.
Yeah. David writes in again. He says, regarding withdrawing from a retirement account, I was able to withdraw without the early withdrawal penalty, and I paid low taxes then because Georgia declared a state of emergency during Hurricane Irma. Sounds very similar, David,
Yes.
to what this new bill that's in Congress right now would allow people, perhaps even across the country, to do. That would be wonderful. That would be a great opportunity, definitely something to keep an eye on if you have retirement accounts and you've been thinking about taking some of that money out.
Of course, maybe we can get some of that money Pelosi sent into the New York theaters.
Maybe. Who knows? Okay.
So one of the questions that came in from George is, how do I track my loans and how do I set up loan repayments to make sure that I am being a good money manager through the Perpetual Wealth Code? And that brings us up to tomorrow. John and I, usually we're out of the office on Friday, but John and I are coming in and we are doing a webinar same time tomorrow. And we're going to talk about money tools and how you can use that software to set up loan repayments and how you can make sure that you're tracking that properly. If you have loan repayments already set up, but you need to adjust it right now during these times, he'll show you how easy that is to do that, where to go and find that information. If you haven't set up policy loans and you realize that when this is over, you need to get some policy loans set up so that you are replenishing your store of cash values in your policy for things like this, then that's going to be a great time for you to look at that. And so you're ready to go with that. So John and I are doing that tomorrow, same time.
Same time tomorrow.
And
Same
I-
time, same place.
We'll be emailing the information out about that. So this isn't announced on the website or anywhere. So this is just, if you're on this meeting, you'll be getting an email about this and have the opportunity to join us for that overview.
I just want to step in here and say this software is so important for you to have. You see, a lot of people think the insurance company is going to keep track of all this for you, but the insurance company isn't a bank. They're going to send you one statement annually about your policy. You are the one that has to be, like Nelson Nash used to say, you have to become your own banker. And banking software is proprietary software. You just can't go out and buy it from the bank. And so John has created money tools as a way to track your loans so that you get to, number one, see if you're making money with these loans and be able to know where it's going. Because if you don't track it, you won't know. And number two, it's going to tell you what interest that you are paying back to the insurance company is deductible and which insurance is not. And it's going to help you keep on top of multiple loans. And when I say multiple loans, we're talking about the velocity of money. And so this is something that traps a lot of people early on in a policy where they say, oh, I've increased my cash flow because of this loan. And they then get bound up in saying, I can use that money again several times, and then don't realize that all their money's tied up, and how are they going to pay the interest on the policy loan? So
It's leverage. When you use it, be careful with it.
but the money tools is what helps you keep yourself very easily. We used to spend hours weekly doing our books. When this software came out, It's 20 minutes.
Yeah.
It makes a
easier.
huge difference.
Makes
So
things
John and
easier.
I are going to go over that. We're also going to talk about, maybe you aren't doing a lot of that setup, but you want to be able to figure out how to make a loan repayment real quickly. Maybe you want to get it automated with the insurance company to make sure that's happening. We'll talk about those things tomorrow at the same time here.
That's right. So a couple of questions we haven't yet got to. I think this one from Anthony is
Oh
one
yeah,
of them.
yep. Anthony wanted to know: should he borrow from the cash values of his policy to fund a new partnership to make an investment? And you got to talk to Anthony about that.
We were talking about this. This was a partnership that was going to be a long distance partnership, and the one funding the partnership was not the one that was on the purchasing end of the partnership. And I just remember what Nelson Nash used to say. When two people go doing business, one has the money and the other one has experience, and by the time they get out of it, it's reversed. So be really
has the money,
careful
the other
about
has
partnerships. So we talked about partnerships and the liability, which was something that you need to understand too. A partnership that is not set up as a limited partnership, you are liable for 100% of what your partners do, both in the business and out of the business. So if someone comes to your partner's house, trips over the front step, falls off the porch and breaks his neck, guess who they're going to sue? They're going to sue your partners, they're going to sue you, they're going to sue everything you own. Lee Phillips is really good about talking about that. We have him speak quite often because they're going to take everything you own if they can.
They're going to try.
All right. So a limited partnership is one thing, but at the same time, can you really afford to be the capital funder of a partnership where you don't really have any experience in this? So if the product that the partnership is going to sell has to be stored someplace, for example, and you don't know how quickly this product is going to sell, what are the storage fees going to be?
Mm-hmm.
Is that going to eat you out of house and home? So always, whenever you take a loan from a policy or are thinking about it, we encourage you to contact us and let's just talk about why you're taking the loan. We're not going to talk you out of taking the loan. We're just going to share with you what are some of the consequences of you taking out this loan and what would happen if you couldn't pay it back. Or what could cause
That's
it
right.
where you couldn't pay it back in a timely manner.
That's right. Great questions. Thank you all for participating today. What about this one from it looks like a few people had this question. Angela, Donna, and Heather. How do I convert my term insurance to whole life? And I think along with this goes the question, are the insurance companies doing anything different? Are they allowing term conversions? Are they doing anything different with new policies right now? Are they limiting what happens or who they'll underwrite with this coronavirus thing going around?
Okay, so general things first. So if you have coronavirus symptoms or you've just come back from outside the country, then they want to wait until that,
Sure.
like 30 days after you've been back in the country
Let
or
yourself
until your
quarantine.
coronavirus symptoms have disappeared, then they'll consider you for underwriting. So, if you were sick anyway, that would be something to be concerned about. So that's pretty simple. Can you convert your term insurance to whole life? Yes, you can do that.
And can you do that even if you have coronavirus?
Yes. Even if you had coronavirus, yes, you could convert it to your whole life
That's good to know.
insurance. So if you suddenly had cancer or you had a heart attack, you can convert your term to whole life. And if you got preferred on your term or preferred plus, they still have to give you that top rating
Nice.
when they convert it. So that's a good question. Term conversion we saw recently. We're still shopping around though, making sure we're getting our clients the very best deal when they go to convert. So that's good. Something else with the insurance companies, some of them have rolled out limited medical requirements. So we're
This
asking
is
medical
amazing.
questions,
Yeah.
but most of the time they're not needing blood and urine. Now, that doesn't mean all the time, but we submit an application with the assumption that we're not going to need any of that. Now, if something comes back with the underwriter and he says, I want you to schedule labs, then we've got to schedule labs. But going into underwriting, no needles. So
Yeah,
that's
isn't that
that's kind of
great?
And that's
exciting.
for $1 million of coverage if
Yeah,
you
up
have
to
a
$1
standard
million of
rating
coverage
or better.
to a
Which is-
certain age, 18 to 60.
which is quite a bit higher than it used to be.
Oh, yeah.
And the insurance companies have been collecting data on this for a while. And so now that they're actually rolling this out during coronavirus, this really speaks to their confidence in the
Yes. It
ability
does.
of that data to predict what they need and to be able to bypass some of that. And for you guys, if you want another policy,
It's
that's
a great time.
all
You don't
around,
have to get poked.
all around. No more needles if it's under $1 million in coverage, or unless maybe there's something on the medical record that the underwriter looks at it and says, you know what, we want to go ahead and see some additional medical records on this.
Right. So it's not a blanket. I guess in the insurance industry, there's no yes, no, yes, no, yes, no.
Yeah.
There's a lot of, different things different factors that come into play. But overall, we're seeing that we can go in without medicals being expected.
So as John said earlier, we are living in interesting times, but the consistency and the stability that the guarantees provide in our life insurance policies gives us an edge over a lot of people because we don't have the financial worry, concern. We actually can experience that financial peace of mind that is so essential to eliminate the stress that so many other people are facing right now. And it gives us an opportunity to reach out to other people and show compassion and and kindness to them. And that too helps us because kindness has been proven to create all kinds of nice hormones that keep us healthier. So it just is, we just couldn't be happier or more pleased with the position that we and so many of our clients are in at this time. It just gives us a very a sense of accomplishment almost because
A purpose.
my goodness,
So many people in the
are
fi-
really struggling.
Yeah. And so many people in the financial industry right now are having to call their clients and tell them the bad news, how
Yes.
much their accounts are down by. Or maybe the clients are calling them with the bad news, scared about how far their accounts are down by. And, with the guarantees and the safety that we have with the life insurance and how we help clients, we get to call clients and give them the good news. And you get to look online and see your policy values. You get the good news. And that is so important in times like this. Hello, Donald from Hawaii. So glad each and every one of you could join us for the YouTube live questions and answer today. If you have a specific question at any time after this session or during it that you didn't want to ask right in the live chat, give us a call, 702-660-7000, or send us an email. We're always only a phone call or an email away. Thanks for joining us. Stay well and be safe.